Good morning and welcome to BDO's Summer Insurance Update. My name's Alex Barnes. I'm a head of insurance at the firm, and I'm absolutely delighted to be introducing you to our key speakers. Firstly, we've got Rob Murray, who is going to talk about the impact of COVID-19 on claims. And then we've got Charles Portsmouth, who's one of our leading regulatory experts, who's going to give you an update on Brexit, COVID-19, and also the PRA and FCA's business plan and what they've got in store for us all. And then finally, we've got both Thomas Toe and Michael Whiteside, who are going to give an update on key tax risks and opportunities arising right now. A few admin points before we get going. Firstly, all lines are muted. So we've got a Q&A function, and please do submit questions. And then all of the session is going to be recorded, and slides are going to be available later. Well, I'm just going to pass you straight on to Rob. Rob, over to you.
Thank you, Alex, and hopefully I've taken myself off mute. Okay, it's one of the most pressed buttons on my screen these days. A big welcome to everyone. It's a real shame that we're not all together in the room, as would often be the case. I do miss out on missing the coffees and the pastries and the chat with you all, but we'll have to make do with this for a little longer and hope that we can find ourselves in more normal conditions soon enough. But the reason we're in these conditions is because of the subject of my topic, which is COVID-19, and in particular its impact on claims. And I will try and stick to brief here and focus on COVID-19. There's going to be one point at which I'll deviate off COVID-19 slightly, but as you'll see when I do that, that's because of an important outcome that's arisen from COVID-19. So you'll see what I mean when we get to that. When I was discussing this section of the talk with my colleagues virtually, I was saying how COVID-19 clearly has been very, very bad. But I think there's a lot of good news from COVID-19 in terms of how insurers have helped to keep things going. So it's not all bad, there is the good. And also from an insurer's perspective, there's some of the good news in those lines of businesses that have experienced fewer claims than they might otherwise do because of the changes in people's behavior and the exposure to risk. So it's not all bad, and I guess it's good and bad. And when I was chatting through with my colleagues, they said, well, why don't you label your part of the presentation as the good, the bad and the ugly? I said, well, I can do the good and the bad. What's the ugly? And they just looked at me. So I can't do anything about the ugly, but let's see if I can take you through the good and the bad today. If we just move on to the next slide. So let's take this from the top down. So the big picture for UK insurance. So I've got some key stats I've pulled out from the ABI here. And this is in relation to 2020 incurred claims, but insurers are expected to pay up to £2.5 billion for UK insurance claims. By far, the vast majority of that, as you'll see there, £2 billion for COVID-19 related business interruption claims. So we will talk a bit more about business interruption shortly in the recent FCA test case. 204 million from COVID-19 related protection, so that's life and critical illness and the like. 152 million on travel insurance claims and 121 million across other general insurance products, so events and wedding cancellations and liability insurance, the like. So that's the top-down view. Just to put that into context, don't have the latest stats for UK insurers' premium income, but I expect it to be somewhere in the region of about £65 billion-ish based on past years. So we're talking about more than 3% of the overall UK insurers' premium income going towards COVID-19 related claims. Let's look at this business interruption in a little more detail, though, given that is the big number on that slide there. So Rima, if we just move on to the next slide, please. Okay, many of you will be aware of the FCA test case, which was pretty groundbreaking in many ways. It's the first such case of its type where the FCA effectively brought together a a case on behalf of policyholders looking at 21 policy wordings from across 8 insurers. This was fast-tracked through the court process, so it avoided the need to go to the Court of Appeal, for example, by having a representative of the Court of Appeal and the High Court at the first hearing. We've gone all the way through to the Supreme Court judgment, which was handed down on the 15th of January 2021. And that there were many parts of the first High Court judgment that were not then appealed and carried, but those bits that were appealed, the Supreme Court decided on. Just worth mentioning at the front, though, I've put that in the first bullet, most UK business interruption policies are focused on the property damage and property damage related business interruptions, so they are unlikely to cover COVID-19. So this test case was very much looking at those where there are clauses for non-damage business interruption as a result of infectious disease at the premises or within a radius, or prevention of access to the premises and the like. So I guess there is still significant economic loss that's going to go uninsured here, but that's where the government is doing its best to try and keep things moving. I know that the insurance market is never intending to cover something as significant as this type of pandemic event, but also I guess that does present some opportunities if insurers felt brave enough to go into trying to more actively provide cover for these types of occurrences in future. The opportunities are there. Significant economic losses can be experienced, and therefore there may well be a need for insurance beyond. The Supreme Court judgment looked at various things. I've just put a list of the key headings under which they gave the judgment. They looked in particular at disease clauses. It was interesting to see what actually counted as an occurrence under those disease clauses, and whether it was the whole of COVID-19 itself as an epidemic, or whether it is each individual person that gets COVID-19 that's an occurrence. And that was essentially the view that they took, was that it was basically a multitude, thousands of cases each day of people getting COVID-19, and those are the triggers under the disease clauses rather than just the overall wave. So I guess that means it does mean that those disease cases need to happen within the radius of the premises, if that's one of the clauses there with regards to prevention of access. It may specify, for example, within 25 miles of the business premises. So you do need to be able to demonstrate that there have been cases within that range, but given the widespread of COVID-19, that's not going to be at all difficult to establish for probably any part of the UK. I'd have thought can probably put a pin on the map and say within that radius there has been COVID-19 cases and occurrences. One thing I did want to highlight, though, and this is where I'm going to go slightly off piece from COVID-19, and that's the overruling of the Orient Express Hotels case. That was interesting, not just for the outcome, but also because the judges who are now on the Supreme Court were actually involved in that decision back in 2010. So it's interesting to see them effectively overruling a decision they made themselves when they were part of the tribunal that decided on the Orient Express Hotels case. And I wanted to flag that as it's arisen from these COVID-19 rulings, but it's going to have far-reaching effects well beyond COVID-19, because the Orient Express Hotels case was one where the insured had a hotel in New Orleans that was damaged through Hurricanes Katrina and Rita. And it was adjudged that the business interruption losses could be reduced because whether or not the hotel had been damaged, there was such widespread impacts on the wider area that they would have suffered business interruption whether or not their particular property had been damaged, which was fairly controversial at the time, to say, you can claim for the coverage that applies to the damage to your property, but you must have the business interruption claim adjusted to reflect the fact that actually you would have lost lots of business even if your property hadn't been hit. So that decision was overruled by the Supreme Court as part of this COVID test case. And that now means that actually it's not just COVID business interruption claims going forward that are going to be affected. So watch out for this in future, where there are perhaps major windstorms or floods that may affect properties or businesses and have a wide-ranging impact beyond their immediate premises, where those claims would have been adjusted downwards for the last 10 or so years. That won't be the case going forward. So that's why I wanted to flag that one, slightly non-COVID issue, but I think it's important. So putting it on your agenda if you haven't picked it up already. But as I said, it's not all bad news for insurers. So whilst the FCA test case did mean that a lot of those policies did actually deemed to provide business interruption cover as a result of COVID-19, there are some good news. So if we just look at the next slide, and we'll just pick up one example. And that's with regards to UK motor insurance, but this also applies to other insurances where the exposure profile may have dropped. So this is the one example I wanted to pick in the short time allotted today. So looking at exposure on the one hand and claims experience on the other, I've pulled out some charts and statistics there from the Department of Transport on vehicle road usage. So on the left-hand side chart there, you'll see the significant drop-off in vehicle usage in 2020 compared with 2019 across all vehicle types. Significant reductions there. And if you look at the exposure in the middle chart there, in terms of the use of different roads, so we've got motorway mileage dropping by 32%, A roads 26%, minor roads 19.7%. So big drops here. But I did want to also highlight this on the right hand side, that whilst most vehicle types have clearly had a reduction, I think it's worth just watching out for that pedal cycle there. I don't mean that in terms of physically watching out for the pedal cycles when you're crossing the road, but you should do that anyway. But a significant increase there in the use of pedal cycles, which I'm sure is no surprise to anybody. Many people have taken the opportunity to get out on a bike during the pandemic. And that is, changing the risk profile on the roads. There's some very interesting charts. I haven't had to be selective here. There's the accident statistics also produced by the Department for Transport. They cover a year ending June. So the last stats that fully published were the ones ending June 2020. But even those show, if you look at the month by month stats, significant drops in the casualties for all road user types. Although as we then go into the June stats, the cyclists' casualties are back up to where they were at 2019 levels, and that's just in the stats to June. So we'll wait to see what comes out in the stats beyond that in due course. But clearly that's changing the usage of the roads and therefore the exposures on the roads. And if you are a motor insurer, whilst you may well find a drop in claims, we'll look at those in a minute, you may also find that the claims that you do have could involve accidents with pedestrians, and of course the bodily injury risks there are heightened. So in terms of the claims experience, which we just showed down below there, so the number of claims settled in 2020 fell by 90%, which is pretty huge. Total payouts reduced by just 6%, and that really was due to both injury claims and repair claims going up in value. On the right hand side there, I've pulled out a couple of stats there for the average value overall of a pay claim and the average personal injury payout. So whilst there's good news for insurers from the point of view of those reductions, there's the the continuing increase in the personal injury payments there, some of which is hoped to be reduced with recent initiatives. I won't go into that because we're keeping the focus on COVID, but I think it is just one to watch. Plenty more we could say. I'll perhaps I'll close off now and hand over for the next slot to Charles, but happy to take any questions at the end of the session as well and cover anything on these particular things we've pulled out here or beyond any of the actuarial matters. Just drop us a question, we'll pick that up at the end. So over to Charles.
Good morning, everybody. Thank you for joining us. I'm Charles Portsmouth, and I'm a director in the governance and risk team at BDO. And my task this morning, for my multiple and manifest sins, is to look ahead at the regulatory agenda for the next 12 months or so and see what might keep compliance officers in your firms busy. I'm going to do this through the following lenses. Firstly, Brexit. Secondly, the current hiatus around COVID-19. And lastly, what was on the PRA's and FCA's agenda and was delayed, and what might be on the agenda going forward. Some of it's taken from the Regulatory Initiatives Grid, which was recently reissued, and some of it comes from elsewhere. Next slide, please. So, looking firstly at Brexit, what's happened since 31st December 2020? Well, just prior to Christmas, the UK and the EU announced we had a deal, and we left at midnight on 31st of December. Equivalence for financial services was the goal, but this did not happen as part of the UK-EU withdrawal deal. And instead, a deadline of March 2021 was set as a deadline for a memorandum of understanding for going forward. In March, it was announced this had been agreed, but no text to it has yet been published. Equivalence, therefore, still seems some way off and may be a no-no forever. So the regulators have thus been busy setting out memorandums of understandings with the various EEA states for regulatory cooperation. The FCA have confirmed firms seeking authorization in the UK will have to meet the same standards as everybody else, including the FCA threshold conditions. The PRA has commenced its Solvency II review, as had EIOPA during 2020. And this is a topic which I will return to in a few minutes. And lastly, the government has been consulting on the future of regulation in the UK through its regulatory framework review. The outcome of this review looks as if it will be that what is currently set out in UK law, such as the Solvency II Directive and the Insurance Distribution Directive, will be transferred into the regulators' rulebooks and removed from the statute book. This will allow the regulators to vary the rules much more quickly than is the case if changes to legislation were needed. And this will be a key difference going forward between the UK and the EU's approach to financial services regulation. And this might well endanger any equivalence agreement with the EU as we move away from their preferred methods and their rules. Next slide, please, Rima. So let's look at the COVID-19 effects. Firstly, from a PRA perspective. Much of what they had been planning for the year was delayed, such as stress and scenario tests for banks. And for insurers, there was a relaxing of the deadlines for solvency and financial condition reports, etc. In terms of financial resilience, the PRA have concluded that insurers were both well capitalized prior to their hiatus and seem to be remaining so. They have not had to use the ladder of supervisory intervention, and they have been careful not to be over-prescriptive in areas which might have unintended consequences, such as an overreaction to the shock to asset values at the beginning of the pandemic. And when they looked at operational resilience, they noticed several areas that might need to be addressed. Firstly, the standard business continuity plans or disaster recovery plans involving moving to other office space were redundant as a result of the instructions to work from home. This resulted in short-term issues for corporate security as IT departments responded to all the technology being used at home rather than in the office environment. The changes also included a lack of visibility for firms over the operation of their outsourced services, such as claims handling, both in terms of their own operations and also the risks to the financial resilience of those providers. And as we're all aware, no doubt, there was an uptick in cybersecurity issues such as phishing emails and ransomware attacks. Next slide, please. From a FCA perspective, the FCA also gave firms some leeway. For example, the final implementation of the senior managers and certification regime for solo regulated firms was moved by 3 months from December 2020 to March 21. The pandemic has focused the FCA's mind from an insurance perspective on 3 particular areas. Firstly, vulnerable customers and the need for treating customers fairly in this area by asking insurers to take into account the extraordinary circumstances in their treatment of customers unable to pay premiums, etc. And I suspect vulnerable customers customers will continue to be a subject to extra focus going forward because of the research that some sectors of our society have been more affected than others by the outcomes of the pandemic. Rob has addressed in detail the business interruption, but looking at it from a regulatory perspective, this was unprecedented steps in the arguments over the cover provided by business interruption policies. The contingency market was heavily hit by losses incurred, but claims were relatively easily made as the event either happened or didn't. The BI claims were much more nuanced by the specific terms of the wording of the clauses contained in the policies, which also varied between insurers. The FCA has probably ensured that claims have been more speedily settled for many by their actions. However, I'm sure that this issue is going to rumble on for some time to come. And lastly, as with the PRA, the FCA have been worried about operational resilience, an area that has been on the regulatory agenda for a number of years, but which has been brought into sharp focus by recent events. And this has culminated in the issue of March this year of both regulators' policy going forward in this area. The PRA released their policy statement and 2 related supervisory statements, with the FCA releasing its own policy statement. I'll return to this area in a little bit more detail in a few minutes. Next slide, please. The PRA released its business plan in late May, and there was nothing particularly new in what it contained. Indeed, some of the agenda items were discussed under my previous slides: the regulatory framework review and financial and operational resilience. Other items are long-standing parts of the PRA's agenda, such as recovery and resolution, and they're still identifying what insurers need to do on this topic. I'm going to discuss the Solvency II review and the climate change agenda in a moment or two. For the effect of their work on EU withdrawal means a short-term extra workload in terms of the temporary permissions regime and the supervised runoff regimes. Next slide, please. The effect on the PRA workload arising from Brexit is outlined on this slide, which sets out the firms in the insurance sector subject to PRA supervision at January 2020 and January 2021. There are 183 insurance firms in the temporary permissions regime, requiring authorization and possibly a Part 7 transfer. And this is a significantly larger number of firms when you compare it with the banking sector. Next slide, please. I promised to return to the review of the Solvency II regime and climate change. Firstly, the Solvency II review, which is likely to be evolution rather than revolution. The PRA support the underlying principles of the regime, but they recognise there are some issues with it. In particular, the risk margin and its sensitivity to long-term interest rates, and this is more likely to be of interest to life insurers rather than general insurers, as is the operation of the matching adjustment. Of more interest today for this audience is likely to be the use of increased proportionality for general insurance firms, and this is likely also to reflect the PRA's desire to have one rulebook for all insurers rather than the current split between directive and non-directive firms. Turning to climate change, all firms should have fully embedded their approach to managing climate-related financial risks by the end of this year. The requirements were set out in a supervisory statement in 2019, and there was also a reminder in the Dear CEO letter issued in July 2020, which sets out the PRA's views on the perceived gaps in firms' approaches to this important issue. As usual, they identified gaps in both governance and risk management, in terms of board engagement and slow progress on risk policy frameworks. They also identified issues around the significant gaps in scenario analysis. And they concluded the gaps have also had an effect on the way firms have addressed climate-related disclosures within their SFCRs and their ORSAs. Next slide, please. Operational resilience. Let's look at this in a little bit more detail. The deadline for compliance is 21st of March 2022, a little under a year from now. For insurers and enhanced FCA firms, this may well cause a significant amount of extra work, as these firms have a year to meet most of the provisions. In brief, it requires firms to identify their important business services, and these are defined as those that might cause an intolerable level of harm for customers or pose a risk to the soundness of the financial system. I guess this means a breakdown in ATM systems or the tap and run systems such that the money or the ability cannot be accessed. From an insurance perspective, claim systems not being able to respond to customers to provide the policy benefits, such as replacement cars on a timely basis. The firms that are subject to the rules will need to start mapping these important business services in terms of potential weaknesses and the time taken to restore the service. They need to set impact tolerances, such as recovery of systems within 24 hours. They need to define appropriate monitoring tools and the related metrics. And this might be a big project for some firms and will require board buy-in, a budget, and a coordinated approach by all three lines of defence. Next slide, please. Let's turn now to the FCA business plan. The 2021 plan would normally have been released in April, but has been delayed until July. What we can say is we have a new FCA CEO, and the FCA needs to respond to the criticism handed out by Dame Elizabeth Gloucester after she looked into the events relating to the FCA's regulation and supervision of London and Capital Finance, which entered administration in January 2019, impacting over 11,000 people who had invested around 237 million with that business. Her report concluded that the FCA did not effectively supervise and regulate London and Capital Finance, and it made 9 recommendations for the FCA, focusing on how they should improve both their internal authorisation and supervisory processes. The FCA is responding to this through its FCA transformation project, which, according to the chairman in a recent speech, will make sure that the FCA enforce the gateway to authorisation, focus on the basics, focus on the outcomes, and use the rulebook better and faster. It will reshape the FCA itself and its operational culture, and ensure the FCA state clearly the outcomes wanted and measure those outcomes and be transparent about whether the FCA have achieved them. As usual, the FCA will have also been majoring on conduct and culture, the senior managers regime, and its effect on a firm's culture and how diversity might help that. The recent censure of Alsford, Page and Gems underlines the continuing importance of firms dealing with conduct risk effectively and of responding properly to the FCA's concerns in this area. A recent Freedom of Information request noted that out of approximately 6,000 solo regulated insurance intermediaries, only 15 conduct rule breaches by senior managers and certified staff were reported last year. That's less than 1%. 10 of the breaches related to certified staff and 5 to senior managers. If this reporting remains lower than expected, the FCA is more likely to step in and investigate firms, and the industry as a whole may face more scrutiny in this area. Firms should probably, the majority of breaches were for integrity issues, followed by due skill, care and diligence issues. Integrity breaches might indicate that firms have more work to do in terms of their culture and making sure that their staff are doing the right thing. And firms should probably note that tick box training and too good to be true reporting, or the lack of it, will not satisfy the FCA. And their continuing agenda on conduct is recognised by, firstly, the recent announcement of the results of their general insurance pricing practices market study with the publication of a policy statement. The new rules on pricing, auto-renewal and reporting come into effect on the 1st of January 22, and the rules on systems and controls, retail premium finance and product governance come into effect on the 1st of October 2021. And secondly, the FCA have also started a consultation on a new consumer duty for both firms and individuals. Next slide, please. Let's look at conduct and culture in a little bit more detail. Some years ago, the FCA started their 5 conduct question programme, which they asked of firms. And in recent speeches, they have been assessing how these are working out in practice. They are stressing a firm's purpose, principle and values. And they believe a healthy, purposeful culture should lead to better outcomes for consumers and markets, and healthy and sustainable returns for shareholders. And it should also lead to a healthier and less stressful environment for employees. And as such, they have welcomed the recent PRA conclusions on the overall effectiveness of the senior managers and conduct regime, certification regime on both culture and accountability. They set out that they're moving from addressing tone from the top to tone from above. Do the lower levels recognise or hear the tone from the top, and also the tone from within? What does that mean for everyone's behaviours within the firm? They're also addressing the issue of greater diversity in terms of both their reaction to those vulnerable customers identified, as I said earlier, as being more severely affected by the pandemic, and their work on the PRA on this issue. The PRA have recently reminded firms of their diversity objectives, and they're possibly making diversity the subject of a 6th conduct question, adding to the current 5 CQs they currently use. And last slide, please. Now turning to the FCA's new proposed consumer duty. Set out in a very recent consultation paper, they're proposing a new consumer principles to apply to all firms. The exact wording of the principle is still being discussed as set out in the consultation paper. They're proposing a series of cost-cutting rules applying to all firms regarding reasonable steps. Reasonable steps is a phrase that is used as part of the senior managers regime within the senior managers rules. And these address a firm's actions which might cause harm and firms acting in good faith. And this will be underpinned by the 4 outcomes for the customer they are seeking in terms of the appropriateness of communication for products and services, the design of those products, and the customer service meeting consumer needs, and lastly, fair pricing for the value of those services. The consultation is open to July, and should you wish to express a view. That's me done, so do please raise any questions you might have. Thank you for your attention, and I'll hand now over to Thomas, who's going to take you through the tax issues.
Thanks, Charles. Good morning, everyone. Hope you're all keeping well. I'm Tom Sawyer. I'm an insurance tax partner at BDO. Today, we will give a quick update on tax, including some key developments from the recent budget 2021. We'll also talk about the IFRS 17 insurance contracts tax implications, and then we'll finish with the off-payroll worker rules in the private sector. So hand over to Mike. Thanks.
Thank you, Thomas. So yes, I'm Mike Whiteside. I'm a senior manager in the insurance tax team here at BDO, and I'm going to talk about a tax update and a bit on IFRS 17 tax issues. So firstly, the budget highlights to cover. So you'll probably be aware the main rate of corporation tax is due to now increase to 25% from April 2023 for large companies. This is a reversal of a rate that's been steadily declining over the last 20 years or so. When I first started full-time in 2004, the tax rate was 30%, and it's been decreasing ever since down to the 19% it currently is at. So this is a reversal of the reduction in rates in previous over the years. There'll also be a marginal rate between the two, 19% rate for the smaller companies and the 25% rate for the large companies. And also it's worth bearing this in mind, in the context of the potential global minimum tax rate that's been discussed over the last few days. Similarly, because of the change in the mainstream corporation tax rate, the diverted profits tax, which aims to tax profits artificially diverted to overseas tax jurisdiction, low tax jurisdictions, will go. That rate will go up as well, in line with the main rate corporation tax. So it will go up to 31%. And then the final thing on this bit is making tax digital for corporation tax. So there was a consultation that went out a little while ago. The consultation was ended. HMRC have not yet released the response outcomes. Making tax digital is due to come in. Currently due to come in 2026, so there's obviously quite a while before it'll come in, and it's going to potentially cover a number of changes to more regular reporting, for example, and the keeping of more electronic records. Also announced in the budget was an investment super deduction, so to encourage companies to continue to invest post-pandemic. The government announced a 130% upfront deduction for capital spend on main pool additions, so normal plant and machinery, capital allowance qualifying items, and a 50% for special rate pool additions. In addition, the annual investment allowance, which is a 100% upfront deduction on capital spend, which was previously due to reduce, is going to be extended to the end of 2021 as well. Another announcement was the loss relief rules. So there has been a temporary extension to loss carryback rules that companies can use. The 1 year carryback, which was always in place, remains unlimited, but for the further carryback of the up to the previous 3 years, there will be a cap of about 2 million for that. Note that the 3 year carryback is limited to trading losses, and you have to offset the most recent profits first, but it is potentially give you a cash flow benefit for tax you can recover from those previous years by carrying the loss back. Research and development consultation. So there was an R&D consultation which closed last week, the 2nd of June, and it covered a wide range of aspects of the R&D regime and had a number of questions around the eligibility of the reliefs, how they're operating, for example, the interaction between the large company SME rules, how they're targeted, etc. And again, we wait for outcome of that consultation, probably be a little while before we get that. Just to say that BDO have a benchmarking tool, so we have a tool which can analyse whether we believe you are claiming enough of your R&D tax credits based on analysis of data. And then just a couple of other wider points, not specifically budget related. So you may be aware that the EU mandatory disclosure regime, otherwise known as DAC6, was due to come in soon. In December, it was the government announced that they were only going to apply. The DAC6 rules were about cross-border transactions that needed to be reported when certain hallmarks were met. So in December, the government announced actually that they weren't going to do that anymore, and the only hallmarks to which reporting was necessary relate to automatic exchange of information, FATCA, and common reporting standards. So significantly scale back of the potential reporting requirements under DAC6. And finally, tax and ESG agenda. So ESG is obviously quite a hot topic for companies generally, and it's worth bearing in mind how you approach tax in relation to the ESG agenda, for example, how you address your tax strategy publication in line with the wider ESG agenda. Next slide, please. So a little bit about IFRS 17 and tax and a few issues to consider. These are our thoughts at this stage. IFRS 17, obviously, the new standard for insurance contracts is due to come in on the 1st of January 2023. So we are, from a tax perspective, expecting draft legislation in 2022. It may be the case that the government puts through regulatory power secondary legislation, so statutory instruments, to sort of get the approach in law with primary legislation to follow later. Like we say, so some of the point, a lot of the points here are our thoughts, our current thoughts on what the tax implications for IFRS 17 will be, but in terms of the detail, we won't know that until the legislation has been finalised, which is obviously a little while away. But fundamentally, we would say, so obviously the IFRS 17 move to IFRS 17 will change accounting profit, and as tax is based on accounting profit, it has a direct impact on cash tax. Similarly, on the transition from the current rules to the new IFRS 17 rules, there will likely be a transitional adjustment arising which needs to be brought into tax or relieved if you've already taxed effectively the amounts already under the previous regime. There, we think there is likely to be some spreading of this transitional adjustment. HMRC has a history of spreading in the insurance industry. So, for example, on the life tax assurance regime changed from being based on the regulatory return to on the accounts, the revenue put in place legislation which spread that transitional adjustment over 10 years. So that was in 2013. So it's not quite expired yet. It's still got a little bit to go. But that is an example of a precedent. We don't know yet, obviously. Again, we have to wait for the draft legislation to confirm whether there will be spreading and to what extent it will be spread. Similarly, IFRS 17, so things to consider, DTA recognition and the introduction with the change in the corporation tax rate, which I mentioned on the previous slide. Obviously, DTA recognition, to extend your recognising deferred tax assets in your accounts based on future profit projections. Those future profit projections will need to take into account the IFRS 17 accounting profits. And so obviously that's a change from what they would have done previously. A couple of other bits. So just to bear in mind in the context of IFRS 17 more generally, R&D credits, for example, it may be that you are developing systems or other infrastructure that is, if it's uncovered some uncertainties, if there's an advancement, there may be some opportunity to get R&D tax relief, tax credits on that spend. So it's worth bearing that in mind if in the wider business you're developing systems to address IFRS 17. And finally, I was just going to say a couple of other points there. Just to bear in mind, senior accounting officer, for example, obviously that's a certification of tax accounting arrangements, and obviously that would be bear in mind in the context of the change in the accounting rules due to IFRS 17. And finally, M&A implications. So it's worth just bearing this in mind if there are any transactions that are going to take place between now and 2023. Worth bearing in mind, for example, what might happen on a transfer of business, for example. For example, if the transitional adjustment, will it come in immediately or following the transfer if the business has been transferred from one company to another, or will it continue to be spread? Obviously, we don't know that yet, but it's when the legislation becomes drafted, it should become clearer. That was all I was going to say. So I'm going to pass back to Thomas, who's going to talk about off-payroll labour in the private sector. Thank you.
Thank you. Next slide, please. Thank you. So off-payroll labour rules. I'm sure a lot of you have been aware that these rules have come in since the 6th of April of this year for large and medium businesses, having been delayed by a year as a consequence of COVID. So that's come in and very much looks at the responsibility is for the company to assess the status of any contractors that they use. I know from talking to quite a few clients that they've dealt with this problem by just getting rid of the problem. So not using contractors and where possible, actually onboarding them as employees, or just not using contractors at all. So that does get rid of the problem. However, as you can imagine, for a lot of businesses, that may not be practical or financially viable to actually take on new employees. So the only solution for them is to still continue using contractors, and particularly in this age of COVID, where they just want some temporary help, assistance for the business. This is the only route they have. So very much have to assess whether they are employees for tax purposes, and if they are assessed employees, then the company has a responsibility to withhold PAYE and national insurance contributions. So lots of interesting things still coming in. Appreciate that this topic has probably bored everybody to death because it's all over the news and it's a very big topic. But we are still getting in actually rather interesting questions from clients. Most recently, had a few questions in from an insurance intermediary talking about individuals that they contract as introducers and paid on commission. So a very interesting one, and also where contractors are indirectly engaged via suppliers who use agencies and agencies or personal service companies. So so very interesting questions, and definitely worth looking at. And whilst for the first year, for this year, it is a light touch. So I suppose a soft introduction, light touch to penalties, but very much responsibility to withhold the correct amount of tax. So so very much, saying to clients, how are you managing and tracking those risks? Do you have the appropriate procedures in place? And also, could you prove that you are taking reasonable care as the regulations require? So that's where I'll finish. Anyway, just a quick reminder, I suppose, of the off-payroll labour worker rules. If you do have such issues like that, or you have concerns, then absolutely very happy to answer your questions, or do speak to your regular contact at BDO. So that concludes our tax presentation, and I'll hand back to Alex. Thanks.
Thanks very much, Thomas. So we just got a few questions to sort of run through. First of all, I think this one's for Charles. The FCA is thinking about new customer FCA is thinking about a new customer duty placed on companies. Will this make any difference to customers' ability to understand the impact of expenses between between different products, and to make choices to minimise the impact of its to really minimise the impact of expenses?
Thanks, Alex. Difficult. I guess if you look at that consumer duty, there's two elements to that in terms of communication around the product and effective communication as to what that product means. And then there's the look at fair value and the pricing of it. And I guess from an expensive point of view, we're talking about commissions that the brokers are earning on the way through, which normally aren't disclosed to the customer, and what effect that has on the premium that is being paid. But I guess the headline price is the premium, and the customer isn't too worried about where those expenses might be shared between the underwriter and the broker, because it's the overall price they're looking at. I hope that answers the question, but maybe Martin, if you've got anything further, you can drop me an email or whatever, and I can answer it later in more detail, or we can have a chat about it. Thanks,
Charles. And now one for Rob. Rob, how are you seeing COVID-19 really affecting the way the operations of insurers are sort of running, and therefore the sort of impact on observing?
Largely, insurers have coped well operationally from the insurers that I've been speaking closely with. I've certainly have been made aware of situations where, for example, the initial moving into lockdown did cause some droppage in the level of business performance. So in the claims functions, for example, I've seen some companies where definitely there was a drop off in claims handling activities, which, to be fair, recovered fairly quickly. We've had to take some care ourselves with these things, because when we're looking at these things in the actuarial triangles, we need to sort of understand whether what we're seeing is indicative of a future a trend that we should project forward, or whether it's a kind of one-off movement. So if, for example, payments have been slowing down, not taking too much credit for that too soon, in case it's just going to catch up later, and vice versa, with some teams where they've had fewer new claims coming in because exposure levels have dropped. They may have been dealing with the older claims. So on the back years, we might have seen the settlement rate increasing. Again, it's not overreacting to that too quickly without actually speaking with the different functions to understand what's going on within the business. So yeah, by and large, coping well operationally, but certainly it's one to be cognizant of and make sure you're thinking about from an actuarial perspective.
Thanks, Rob. And now going on to Thomas. So over the weekend there was so over the weekend there's the announcement that the sort of G7 are planning a sort of tax treaty. What sort of impact do you think that's going to have on the insurance market? I know it's very, very early days, but any sense from your side?
Yeah, thanks, Alex. No, that's a huge announcement by the G7 countries. At the moment, we don't have the detail, but what do we know? We do know that they are proposing a minimum 15% tax rate, and we do know they are targeting profits in excess of a profit margin of 10%. But what does that really mean in reality? 15% tax rate on what? On revenue, turnover, or on bottom line profit? So that needs to be worked out. And it's certainly for insurers, and I think insurers, particularly with internal offshore insurance to locations like Bermuda, for example, which are low, or the no tax jurisdiction, very much looking at this particular policy. But again, for insurers, what's the profit margin? Is it the loss ratio? Is it the combined ratio, or is it bottom line profit? So, or is it return on capital? Insurance is all about capital. So that remains to be seen. And also, it may well be the case that financial services is excluded from this. We don't know. So I think it's very much watch this space, Alex, particularly so for insurers with those sorts of offshore reinsurance type arrangements in place. And also I finished by saying that we don't know whether there'll be wider buy-in outside of the G7 countries, because really we do need coordination between all these different countries. But at the moment, it's just a G7 who signed up to this.
It is interesting, isn't it? And then one for Michael. What are the tax accounting implications for the 25% corp tax move in 2023?
Thank you, Alex. Yeah, so the 25% is due to apply from April 2023. The Finance Bill 2021, in which that legislation was included, has been through the third reading in the House of Commons, so it's now substantively enacted. So for any balance sheet dates from now, you would be valuing any deferred tax items that unwind after 2023 at the new 25% rate. Yeah, that's it.
Really good. Thanks very much. I think we've come to the end of the I think we've come to the end of the presentation this morning. So many thanks to all speakers, and thanks all for joining us this morning. And we are going to send around the slides and a recording of the talk this morning as well. So many thanks all for joining us. And have a really nice day.